Have you ever bought something that was supposed to change everything, and then a year later it just disappeared? Like, maybe you bought a smart device, a new app, a subscription, whatever. You used it for a few weeks, then one day you open your email and it's like, "We regret to inform you this product is being discontinued." And you're sitting there thinking, wait, didn't everyone have this? How did this fail? Here's the uncomfortable part. That product didn't fail. You just weren't the customer. My name is Nick, and I spend way too much time thinking about how money actually moves behind the scenes, not how we think it moves. And if you're someone who's ever wondered why companies can burn billions of dollars, shut down failed products, and somehow still make their investors richer, make sure to hit that subscribe button. And if this video helps you think differently about money, give it a thumbs up. It genuinely helps more than you think. Because today we're talking about something most people completely misunderstand. Look, here's the assumption most of us grow up with. If a product fails, the company lost money. That's how it works in our personal lives, right? You buy something you don't use, you wasted money. You start a side hustle that doesn't work, you lost money. So naturally, we assume companies work the same way. They don't. Here's what most people don't realize. Some of the most failed products in history were financial home runs. And once you understand why, you'll never look at business or your own money decisions the same way again. Let's start with one of my favorite examples, Juicero. If you don't remember it, Juicero was a $700 Wi-Fi connected juicing machine. Yes, $700. And here's the kicker. People found out you could squeeze the juice packets by hand and get the same result. The internet roasted it. Late night shows destroyed it. The company shut down. Total failure, right? Wrong. Juicero raised $120 million in venture capital. Investors? They didn't lose everything. Early investors exited at valuations that still made them money. Executives got paid. Engineers got paid. Vendors got paid. The product failed. The business, it did exactly what it was designed to do. Here's the thing. Most products are not designed to succeed long term. They're designed to achieve one of three financial outcomes. 1, increase company valuation. 2, generate data. 3, create strategic leverage. Profit is optional. Let me explain. Take Google, Google+, Google Glass, Stadia, Inbox, Reader. All shut down. But here's the math. Google isn't valued on individual product profits. It's valued on growth narratives. When Google launched Google+, Wall Street didn't ask, will this be profitable? They asked, can Google compete with Facebook? At the time, Google's market cap increased by tens of billions of dollars simply from perceived competitive positioning. That's it. No profit required. If a product increases expected future dominance, it already did its job. Now, you might be thinking, okay, Nick, but that's big tech. That's different. It's not. This works because of how humans price the future. We don't value what is, we value what could be. Behavioral economists call this option value. A product doesn't need to succeed, it just needs to keep the possibility alive, and markets will pay absurd amounts of money for that possibility. Let's talk Amazon. Fire phone. Total disaster. Lost an estimated $170 million. But here's what most people don't realize. The Fire phone gave Amazon patents in mobile UI, deep consumer behavior data, supply chain leverage with manufacturers. That data fed directly into Alexa, Echo, and Prime ecosystem. Amazon stock between Fire phone launch and shutdown up hundreds of billions in market cap. That failed phone helped fund your Prime deliveries. Let's do simple math. Imagine a company spends $300 million on a product. The product fails, but during its life cycle, company valuation increases by $5 billion, founders sell 10% of their shares, executives receive stock-based compensation. That's $500 million in liquidity created. The product lost money, the people didn't. This is why failure looks different depending on where you're standing. Here's what most people don't realize. Some products exist only to block competitors. Google doesn't need Stadia to win. They needed Microsoft and Sony to think Google might win. That changes negotiation power, talent acquisition, and partnership leverage. Same with Meta hardware, Apple services, Netflix experiments. Failure can be a threat signal, and threats are valuable. Here's where I get slightly frustrated, because people apply the wrong lesson to their personal finances. They see companies fail forward and think, failure's good, I'll just try things. No. Companies can afford strategic failure because risk is spread across investors, losses are subsidized by equity, upside is asymmetric. You don't have that, but you can steal the framework. Step 1. Separate learning value from profit. If something teaches you something, a network or leverage, measure that value. Step 2. Limit downside, expand upside. Don't bet rent money. Bet money that caps your loss but multiplies outcomes. Step 3. Ask who benefits if this fails. If the answer isn't you, rethink the move. Step 4. Build optionality. Skills, cash reserves, reputation. These are your personal failed products that pay later. Here's the big takeaway. Most failed products didn't fail financially. They failed optically. And once you understand that, you stop feeling bad about every imperfect decision and start designing your money moves with asymmetric outcomes. Not every move needs to work. It just needs to put you in a better position for the next one. If this video changed how you think about money even a little, that's a win. Because wealth isn't built by avoiding failure, it's built by failing in ways that still move you forward. Subscribe if you want more breakdowns like this, and I'll see you in the next one.